Hello again, traders. Doing trader once again from DRFX, Swing Trading Mentoring. Going to be taking a look at 8 currency pairs that I think will provide us with trading opportunities within the next 24 to 48 hours based on the signals and the patterns that have been formed on the respective daily charts and forward charts. Now, before we go into the analysis of these 8 pairs, which is basically a follow-up analysis on the 8 pairs that we did yesterday, what I'm going to do is to basically show you the main approach that is taken to identify trading opportunities on the daily chart and the forward chart. Now, the basic approach is that we identify the market direction by identifying the patterns and signals that are provided by the daily chart and the forward chart. So we identify basically whether or not the market is trending, if it's in an uptrend or a downtrend, or if it's moving within a period of, if it's moving sideways, that is leading to the formation of a consolidation setup. So whether it's trending or moving in consolidation, we identify what is taking place and identify if there are any trading opportunities to take advantage of what is happening on these time frames. So once a trading opportunity has been identified, entry then takes place in most cases using the signals provided by the forward chart. Sometimes entry will take place based on the daily candlestick signal, but in most cases what we do is to enter based on the signals from the forward chart. To protect the trade, the stop loss area would be the area provided by the forward chart in most cases. However, if the stop loss is going to be too large, then we will go down to the 1 hour chart and identify a stop loss on that time frame. So this is the basic approach in terms of identifying market direction, using the daily chart and the forward chart to identify what is taking place in terms of a trending market or a consolidating market. Entry then takes place in most cases using the signals provided by the forward chart, and the stop loss placement is usually done using the signals and patterns provided by the forward chart, and in some cases we would also use a 1 hour chart to protect the trade. Now, in terms of our trading targets, mainly what we do is identify trading targets of between 50 pips and 70 pips that are like to take less than 24 hours. In some cases, we're justified. We'd also target trading setups that take up to 2 days. And sometimes we can, in those cases, we will target trading gains of between 70 pips and 100 pips. But for the most part, what I found is that the most reliable signals and patterns are the most frequent ones that provide reliable setups are the ones that provide trading gains of between 50 pips and 70 pips within a 24-hour holding period. So that's a general idea in terms of identifying market direction as well as trading opportunities. Now let's get into a little bit more detail in terms of when we are trading trends and when we're trading consolidation patterns. Now, in terms of trading either an uptrend or a downtrend, the main idea is to trade in the direction of the market. So if we're talking about an uptrend, we're going to be trading primarily or only bullish signals that are in sync with the movement that is taking place in the direction of the trend. So we would ignore the bearish waves because those tend to be more volatile and risky to trade, and focus only on U-turns that indicate that the market is going to be continuing in the main direction of the trend. In the case of downtrends, we do the opposite. We ignore the bullish movements that are taking place against the trend direction and focus only on the bearish movements and signals that are in sync with the main trend direction. Now, there are actually 2 things that can actually happen when the market is moving within a strong uptrend or downtrend. Basically in terms of what takes place when the market pulls back. Now, when the market pulls back, in the case of an uptrend, we would draw counter trend lines. It can do one of 2 things. It can pull back and then form a counter trend line setup where we draw these counter trend lines up below, well, either above or below the pullback candles in the case of an uptrend or downtrend. And then once the market breaks below these counter trend lines, it would indicate the continuation of the existing trend direction. So when the market pulls back to these trend lines, this is one way in which the market can resume the trend. by basically breaking these counter trend lines with a simple U-turn and a strong bullish or bearish signal. Now, another thing that the market can also do when it reaches these areas, these trend lines, when it pulls back, is to actually move sideways and provide us with one of 4 types of consolidation patterns. The market can either move sideways and allow us to draw horizontal boundaries of resistance and support. That would allow us to basically, which is also known as a range setup, or it can do so by forming one of these 3 types of pennants, where the resistance and support boundaries are formed at different angles to each other. So that is what I'm going to be talking about now in terms of what can take place at these trend lines, whether we're talking about an uptrend or a downtrend, and basically talking about the better and the most reliable signals that we should trade depending on the trend direction. Now, in terms of an uptrend, the priority is going to be, as I said before, to trade the bullish signals that are in sync with the existing market direction. So what this means is that if we're in an uptrend on the daily chart, we're basically going to be trading towards major resistance. And as part of that movement towards these major resistance points, when the market pulls back with these bearish movements, it can do one of 2 things when it reaches this area. It can move sideways for a little bit and then form one of those 4 types of consolidation setups, or it can simply pull back and then U-turn to resume the uptrend. Now, whether in either of these situations, the better option is always to trade the bullish movements that take place that are in sync with the market direction. Movements that take place against the market direction, whether we're talking about movements within consolidation or these pullbacks, counter trend line pullbacks, these tend to be more risky with less reliable entry signals. So we would ignore these pullback candles and these pullback movements within consolidation and trade only the bullish movements that are in sync with the market direction. So even within consolidation, even though we will have bullish and bearish waves that take place, the ones that are found to be the most reliable are the ones that are always in sync with the existing trend direction, because there's more momentum and more market support for these types of movements because they're in sync with the existing trend direction. And you always want to be on the side of the market direction, because at any point in time, we could actually be trading the move that actually leads to the breakout that would indicate the continuation of the existing trend direction. So we ignore bearish candles and bearish movements within consolidation. We ignore bearish movements that are taking place as part of the temporary pullback and only focus on the bullish movements that are taking place in sync with the market direction. Similar situation on a downtrend. Once the market is in a strong downtrend and the trend line is holding, we would focus only on those movements that are in sync with the bearish direction of the market. So this will continue until the market reaches a major support point that will lead to the end of the trend and the possible start of an uptrend. So when we're talking about, so if the market is moving within a small consolidation setup at these areas here, we would only trade the bearish movements that take us from resistance to support and ignore these pullbacks because of the volatility that is normally associated with these movements. And with temporary pullbacks that lead to the formation of counter trend lines, we'd ignore these pullbacks and only focus on breaks of these counter trend lines with strong bearish signals that are in sync with the market direction. So that's it in terms of how we go about identify trading opportunities. If the market is trending, bullish or bearish, we'll either trade counter trend line breaks or movements within consolidation that are in sync with the market direction. And we do this in the case of an uptrend until the market hits a major resistance. And in the case of a downtrend, we continue to trade in this direction until the market reaches a major support point. Now, when it comes to consolidations that are formed as part of a major uptrend or downtrend, there are actually 4 ways in which we can take advantage of these movements. The first one is where we identify a consolidation setup that has already been formed. And what we simply do is to trade between the bounds of resistance and support and trade the waves that are in sync with the existing market direction. The second approach is that if the market is in the early stages of forming consolidation, we'd also trade those early waves until the consolidation has been completed. So whereas most persons would tend to wait until the consolidation has been finally completed and then trade between resistance and support, what I found is that there are certain bullish and bearish waves that tell us that the market is going to be forming consolidation. And so once we can spot these early waves, we can trade them to capture early trading gains until the consolidation has been finally completed. The third approach when it comes to consolidation is to trade breakouts that take place either at resistance or support. So if the market is in a strong downtrend, we would ignore breakouts that take place at resistance because those are usually risky and tend to fail. And we focus only on the breakouts that are taking place in sync with the market direction. The fourth setup with respect to consolidations is that of false consolidation breakout reversals. So these are basically setups where the market will attempt a breakout at one end of the consolidation and then fail to continue the breakout and then U-turn to take out that initial breakout signal and then take us back inside of the consolidation and then break out at the other end of the boundary. So what we would normally do is to identify these setups, and what you will find is that false consolidation breakout reversals normally take place when the market is moving against the trend direction. So if this is in a strong uptrend, then it is likely that that will be the reason for this breakout failing, and which would give way to the reversal and the movement in sync with the main trend direction. So we would trade false consolidation breakout reversals that initially fail to start a movement against the main trend direction and then provide us with U-turns and aggressive reversals that take us back inside of the consolidation and start a breakout at the other end of the boundary in sync with the main trend direction. So those are the four main approaches that we take when it comes to trading consolidation, so long as with the main important criterion being that we're trading these movements in sync with the main trend direction. Of course, once we have identified the main market direction and we're trading either a counter trend line break or movements within consolidation, very important that we trade the most reliable entry signals. So whether we're talking about the bullish signals or bearish signals, we're going to be looking out for the strongest ones that are most likely to provide us with the best trading opportunities. Now, in terms of a follow-up analysis on the Australian Canadian dollar, the last time we took a look at this, we had noticed that the market was forming a consolidation setup on the forward chart, and that what was expected to take place here was a bullish movement that would then give way to a bearish movement down towards support. But as I said in that video, my preference would be to wait until the market provided us with a bearish movement, because bullish movements in this situation would be risky because it would actually be taking place against the main trend direction. So taking a wider look at the situation on the daily chart, you can see that the market has actually been in a strong downtrend, allowing us to draw this outer downtrend line and this inner downtrend line. And so therefore, any movement, any trading opportunities that the market presents for us, we would only focus on those that are in sync with the main trend direction. So that is why I had said that this would have been my preferred trade compared to this, because of the fact that we were trading in the main direction of the trend. And as you can see here, in terms of what actually took place the next day, you can see that the market did not actually rally, but instead it became volatile, reversing, and then now moving sideways. So this is one of the reasons why we do not, that I recommend that we do not trade against the trend, even if we're talking about trades within consolidation. So the movements that take place within consolidation that are against the main trend direction tend to be risky. Some of them can work out, but in most cases, they tend to be volatile and not worth the risk. So here was an example of this taking place, of this risk, which if you had started to trade as bullish, you would have been stopped out by the reversal that took place because we were trading against the main trend direction. US Canadian dollar. A couple of days ago, we basically identified the possibility of a trade on this pair where the market was in a consolidation set up in the form of a range on its 4-hour chart, in a strong uptrend on both the 4-hour chart and the daily chart. And so the expectation, or the preferred trading opportunity, was to look for a bullish U-turn that would take place either at support or after temporarily breaking below support, to then U-turn and head back inside of the consolidation. So that was the setup and expectation. Trading in the direction of the main trend on the daily chart, which you can see is a definite uptrend with a strong uptrend line. Moving forward, we can see that the market did in fact start to reverse after breaking up briefly below support. This essentially provided with a strong reversal candle to indicate the start of the movement back to resistance. So what we were expecting was that the market would provide us with a trading opportunity after a temporary pullback, and then provide us with another bullish signal to confirm the move to resistance. Now you can see here that the market rallied a little bit and had now started to pull back, and so the expectation at this stage was that the market would probably pull back a little bit or move sideways and then U-turn and provide us with a signal to continue the movement towards resistance. And as you can see here, the market, after this pullback, it actually rallied. And so we could actually see the market provide us with a signal at this area here that would take us towards resistance. Now, depending on where the market closes, we might not actually get much from this trade because of how high we already are and how close we are to resistance. So perhaps if the market were to pull back a little bit and then provide us with a U-turn a little lower, then we could it could actually provide us with a larger trading gain. But even if it provides us with a signal at this area here, perhaps what we would have to do is to wait until the market pulls back a little bit to get a lower price, a better price, that would allow us to capture a strong trading gain towards resistance. So that we're going to be looking out for this in terms of a trading opportunity, depending on the size of the candle and the distance left towards resistance. Aussie Swiss franc. Last time we took a look at this, the market had formed this pennant setup on a 4-hour chart. And the expectation or the preferred trade would be to trade the bearish movement that would take us from resistance to support. Reason for this was that the market was in a strong downtrend, as you can see here on the daily chart, where the market was not only in a strong downtrend, but was also breaking up bearish from this large pennant consolidation setup. So the market was moving sideways a little bit after hitting this major support point, but the expectation was that the market would still continue to move bearish. Given the size of this consolidation and the fact that breakouts from consolidation of this size generally take a long time before they actually end. So the breakout is expected to take a longer time to expected to last longer in terms of gains for the Swiss franc. So this movement sideways is expected to give way to continued bearish movement. Euro Swiss franc. The situation here was a similar one to the previous one on the Aussie Swiss franc, I believe that we took a look at, where the market had formed this 4-hour consolidation set up in the form of a range and was now possibly starting to rally. And then the preference here would be to trade the bearish movement instead of the bullish movement, because this bullish movement would be against the main trend direction. As you can see here from the wider look on the 4-hour chart, the market has been in a strong downtrend in favor of the Swiss franc, and so the idea was to only trade and focus on the bearish opportunities that the market would be providing. So the idea was to wait until the market rallied and then only trade the bearish movements that are in sync with the main trend direction. So trading this bullish would not have been the recommended option, because it was possible that this movement would be bullish and would be volatile, and so would be risky to trade. And moving on to see the current situation, you can actually see that the market did in fact become volatile. It did provide us with a bullish signal, as you can see here, but well, you may have been able to capture some trading gain, but in most cases, most of us would have been setting our target at the resistance boundary. And so you can see that the market would not have reached our target. If you were one of those who watched your trades and you knew that the market was going to be, well, if you decide to exit the market at this area, you would have got a trading gain. But for others who probably closed their charts and were hoping that the market would eventually hit this resistance, this is what we would have seen as the market started to reverse and take out this signal. So this is an example of volatility that can take place when the market is moving against the main trend direction. And so it is highly recommended to avoid these movements that are taking place that are against the main trend direction. Euro US dollar, strong downtrend on the daily chart, as you can see here. And the expectation is that the market will eventually reach the support point at 1.0263. Now, moving forward in terms of taking a look at the situation on the forward chart. Earlier this week, we had basically made a projection that this reversal was going to take us back inside of the consolidation and initially back towards support before breaking out and eventually leading to the movement that would take us down towards this major support point on the daily chart. Moving forward, you can see that the market continued to move a little bit lower, but it then encountered some bullish resistance with the market pulling back. But the expectation was that the market would still U-turn and eventually make its way down towards this area. Now, to take advantage of these types of movements, the expectation was that the market would provide us with a strong bearish signal that would provide us with a confirmation and a strong trading opportunity to take advantage of this movement bearish. However, the signal that was given was an evening star, was a bearish signal, but it was the weaker type that I generally try to avoid because these are not that reliable. And they generally have a tendency to lead to a reversal. So that was why I decided and basically posted this or put this label here, basically indicating that there was an increased chance of a reversal because of how weak this signal is. Nevertheless, it was still possible that the market could decline to support, but trading this would have been risky because of the weakness of this candle. Well, as you can see now, the situation is that the market actually continued to move bearish, responding to the signal, and is basically almost reaching the support target. Nevertheless, well, if you were one of those who took the chance, you would have been capturing a small trading gain. However, there are a couple of elements that I see in this that would still have made it the wrong decision in terms of trading this. First of all, you can see here that after the market closed with this bearish candle, there were 1, 2, 3, 4, 5, 6, 7 candles, 4-hour candles, and not one of them, well, and this 8th one right now, and the market has still not hit support. Now, as I said before in the early part of the video, when we're trading signals that are based on the 4-hour time frame, if the market is going to provide us with a strong trading gain, it will normally provide us with that trading gain within 24 hours. So this movement to support would have taken a very short period of time. As you can see, there's a very small distance between the signal and support. And so if the market was going to providing us with this movement, it would have hit the target within 24 hours. So this was a sign that after 24 hours, if the market has not hit the trading target, then it will either reverse or probably take a longer time to hit the target. So waiting until the market hits our trading target can be a little bit stressful. And so that is why I limit my trades to 24 hours. Because anything beyond that is a little bit risky. Because one, it increases the chance of the market reversing. And two, it's wise in terms of not holding on for too long for a trade. Basically because of how stressful it can be in terms of holding on to a trade for a very long period of time. So those are the two reasons why this may not have been the best trade, because of how long the market is taking to hit the support target, and the fact that the longer we hold on to our trade, the greater the chance that the market can actually reverse. Nevertheless, we're going to still be assuming that the market is going to be continuing bearish, because this is the main trend direction of the daily chart. Still a possibility of a reversal, but for the time being, we're going to assume that the market is going to be continuing this bearish movement. And so what could happen next is that the market could then break below the support boundary, providing us with a stronger signal that would eventually take us down towards the support target at 1.0268. So we're going to be looking out to see what takes place on the forward chart within the next 24 hours and make an analysis in terms of a possible trade. Pound Japanese yen, following up on this currency pair. Strong downtrend on the daily chart, as you can see. And so the expectation was what we will be doing would be to look for bearish opportunities that are in sync with this main trend direction. So what we had seen was that the market had moved between above this inner downtrend line and the outer downtrend line, with these two small uptrends, an inner uptrend line and an outer uptrend line, which you can also interpret as being counter trend lines as well. So one of the ways in which one of the things we were assuming in terms of a possible trade was that the market would eventually lose momentum at this area here and eventually start a break below these trend lines. Now, one of the possibilities was that the market could do so by forming a double top signal that would initially break below these trend lines and then start the movement bearish below this outer uptrend line, and then provide us with trading opportunities as it made its way towards the support point. So double tops at the time earlier on this week was one of the ways in which the market was projected to possibly start this bearish movement. Now moving forward, you can see that instead of a double top formation, the market looks more to be forming a bear crown setup, with this being a left tip, the center tip that started the U-turn and the break of these trend lines, and a right tip that has now been formed with we could also see that, this is also looking to be a double top formation as part of the right tip of this formation. So this is another market pattern that indicates a possible start of a trend change. And so what we would need would be for the market to continue this bearish movement and break below this outer uptrend line and start the movement bearish once again. So that is what we would need to confirm the bearish movement and look for trading opportunities that are in sync with the main bearish trend direction. Aussie Kiwi, we still think that this is going to be bullish over the next couple of days, based on the fact that the market looks as if it's forming a range consolidation set up on the daily chart, which will eventually, as part of that movement and part of this formation, take us up towards resistance, where it will then U-turn and provide us with a bearish movement that will lead to the completion of this range consolidation setup. So we basically were saying that as part of this movement, and assuming that the market was going to be headed towards this resistance target at 1.0728, we were looking out for bullish signals on either the daily chart or the forward chart to take advantage of this movement. Now, taking a closer look at what is happening now on the forward chart, you can see that the market has actually started to pull back and form a counter trend line setup. And so the expectation is that the market would break above this counter trend line and then provide us with a strong bullish signal to indicate the start of the movement towards this area here. So either this signal or maybe another signal higher up would provide us with an entry opportunity to take advantage of this movement towards resistance. So that's what we're going to be looking out for over the next 24 hours in terms of a possible signal that is strong enough to justify taking advantage of this movement. New Zealand Canadian dollar, a strong downtrend, and expectation, as you can see here, is that the market will eventually make its way down towards this major support point at 0.83198. And so what we will be doing is to looking out for trading opportunities with bearish signals that will take us down towards the support target. Now, taking a closer look at the forward chart, you can see that the market has actually formed a small pennant consolidation setup. And so the breakout from this could be the signal that would indicate that we're now we will be getting ready to hit this major support target. So what will be needed here is a break of support with a strong bearish candle, and then we would place our stop loss either above the resistance area of the pennant or above the trend line, and then target the trading gain as the market eventually hits the support point at 0.8319. So that's the idea in terms of what is taking place on a 4-hour chart right now. This looks like the setup that could give way to the movement bearish. And so as long as the signal, if the signal is strong enough, then we would look at it in terms of a trading opportunity to take advantage of it as it makes its way down towards support. So that's it in terms of the analysis of these currency pairs, as well as the approach that is taken to identify market opportunities in terms of whether or not the market is trending bullish or bearish, or whether it is moving in a consolidation pattern, or whether it has formed a counter trend line that will allow us to trade in the main direction of the market when it breaks these counter trend lines. Nevertheless, these are the setups, these are the challenges that we face when it comes to trading the currency market. In terms of trading setups that we have identified. The first and most important is that we have to ensure that we have drawn the setup correctly. So whether we're talking about an uptrend or downtrend, the lines of the uptrend lines and the downtrend lines have to be drawn correctly so that we can be assured that we're still trading within the main trend direction. When it comes to consolidations, we have to ensure that we have accurately drawn the lines of resistance and support, so that we know exactly when the market is still within consolidation and when the market is actually starting a breakout. Of course, we have to determine whether or not the signals that are provided by the market are in sync with the main trend direction. We trade in main trend direction and ignore moves that are against the main trend direction, and we focus on the signals that are strong and that have a high probability of providing us with a profitable trading opportunity. Also important is that we place our stop loss at the strongest area to protect our trade. In most cases, we use a 4-hour chart to protect the trade. But from time to time, if we're justified, we'd also use a 1-hour chart. And in either case, we have to ensure that the stop loss is placed at a strong area that is like to protect our trade against temporary pullbacks until our trading target has been hit. And of course, the decision in terms of our trading target, whether or not we should exit the market before support or resistance, in terms of whether we're trading within consolidations. So sometimes you can have a situation where the market will move towards our support or resistance target, but sometimes the market has a tendency to actually pull back and reverse and head back to the other side of the boundary without it hitting the resistance or support target. So there are certain situations in which we can know beforehand when the market has a high chance of actually hitting the support target or resistance target, or whether there's an increased possibility of the market reversing without actually hitting that boundary. So knowing those two situations is going to be very important in terms of ensuring that we're able to maximize on these movements ahead of the reversals. And of course, we have to ensure that we're targeting a strong enough pip target, because we want to ensure that we're not aiming too high nor aiming too low. If we're aiming too low in terms of pip targets, then it will not provide us with the rate of return that we want. And if we're targeting too large of a pip target, then it means that we'll be holding out for too long and increase the chance of the market reversing and taking out our trade. So the 50 to 70 pips is the ideal target that I believe is best in terms of being able to allow us to capture a strong trading gain, while at the same time ensuring that we do not spend too long in the market because of the possibility of a reversal that can take place. So that's it in terms of how we identify market direction in a trending market as well as within consolidation. And in terms of these 8 currency pairs, the US Canadian dollar is, as well as the Aussie Kiwi and the New Zealand Canadian dollar. These are the 3 ones that we're going to be looking out for in terms of a trading opportunity, to take advantage of them as they head toward their respective targets. So as usual, if you have any questions, you can let me know by emailing me at shepherddoing@gmail.com. So until next time, traders, happy trading and all the best.